Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. I'm really excited today to talk about probably my favorite stock, even though it's an ETF, but my favorite ticker symbol, and that is the QQQ ETF. There's a lot of reasons to get excited about this ETF, particularly if you're like new to investing or you're trying to find a sort of set it and forget it strategy for longer term. The QQQ makes an attractive option for a lot of different investors for a lot of different reasons. We'll go through all the details of this ETF, why it's good, what are some concerns, and what does the outlook hold beyond 2020. Reminder as always that my stock picks and projections are just my opinion for your entertainment. Please talk to a financial professional before taking on the risks of the stock market. However, if you do enjoy stock market analysis and personal finance videos, I do post here 3 or 4 times every single week, so make sure you subscribe to the 40 Finance channel. And finally, if you're interested in joining my email list, I've got a link in the description down there. You get my free 15-minute stock analysis guide. This is a great PDF report with tons of free resources to help you do more efficient research. All right, let's kick things off by seeing where QQQ is today. You got a stock price of $275.90, and I highlighted a couple boxes here. If you look down, this one does have a dividend, currently 0.55% of today's price. This is a very popular ETF, perhaps the most popular, I'm not sure, but it has high volume. So high volume of trading activity, which is good for investors because we have the opportunity to buy into dips and also see fast appreciation if things go the right way. On the bottom right there, you see the expense ratio. This is how much it costs you to hold this ETF. Expense ratio of 0.20%. I can tell you that that's very, very low, very similar to what you would see with a Vanguard type fund. And you see the note at the bottom. It ends up costing you $2 for every $10,000 you have invested every year. So to make that simple, if you had 50K, you would pay $10 every year that you had 50K in holding. And lastly, if you look at the 5-year chart here and you see how this ETF has grown over time, obviously accentuated with the hot market that we've seen here. Trying to eyeball this chart, it looks like 5 years ago, you may have been into the $70 to $100 range. And then today, 5 years later, you're sitting at $276. All right, so for investors like me, the big selling point for QQQ is it represents a basket of the top 100 stocks on the NASDAQ stock exchange. Now, some people make the mistake of thinking that the NASDAQ stock exchange is only tech stocks. So the top 100 of the NASDAQ would just be the top 100 tech stocks in the world. Now, while the NASDAQ is very tech heavy, it's not exclusive to technology stocks. And we'll see in a little bit that there's plenty of other food and beverage, healthcare, stuff like that. On the flip side of the QQQ, you have a lot of investors and analysts who would recommend either a total stock market index fund as a great strategy for stock market investing, or they would say just invest in the S&P 500 as a sure and safe bet for long-term wins. But as I'll show you in a minute, there are some advantages to just focusing on the top 100 performers as opposed to spreading out your bets against hundreds and hundreds or even thousands of stocks that are being traded. Okay, so this is a chart pitting QQQ against the VOO, which is the Vanguard's S&P 500, and the VTI, which is Vanguard's total stock market index. These 3 ETFs probably represent, the most popular names that you'll hear across ETF investing. And if you look off to the far right, just to skip to the end for a second, this chart spans from August 2nd, 2008 to October 2nd, 2020. And if you look off to the far right, you can see that the QQQ, which is the blue line, has returned over 500%, VOO coming in over 200%, and VTI, which is the total stock market index, is up over 100%. So all these funds have performed very well, but the QQQ has been significantly better, and that fact remains even if you want to kind of nitpick. So I wanted to sort of take a contrarian look at it. So I highlighted this blue box down here. This is coming out of, the real estate crash and the market crash of 08, 09, and I sort of waited for things to get back on track there. But if you just look for the blue line and compare it to, let's just say, the orange line, which is S&P 500, you can see that even prior to this sort of technological revolution that we've had over the past 3 years, that the QQQ had already started pulling away from the VOO. And obviously the VTI is never really in the race here. I personally just think that there's too many stocks in there to even bother. If you're not interested in the QQQ, then I would recommend the VOO, which at least breaks it down to S&P 500, and it bases your investments, essentially in America, which has outperformed the world markets significantly. All right, so the most important question with QQQ or any other ETF is, what are the holdings? What does this fund comprise of, and can I get behind those names? Can I feel good about investing in these names? So let's jump into the QQQ and see exactly what is in there. Okay, so don't worry, we are not going to go through all these names, but I just wanted to put this up so you could eyeball it yourself. You'll notice that it is a market cap weighted ETF, meaning the bigger stocks hold a bigger percentage of the portfolio. As you know right now, FANG stocks in particular are very top heavy on the market, and you can see with QQQ, Apple, Microsoft, Amazon comes in at about 33% of its current holdings. That's key, right? Because some people will view that as a negative. They will say that the market's too top heavy. What if all three of these stocks crash at the same time? Then the whole thing's wiped out. I guess I would answer that by saying the likelihood that all three of these companies go down at the same time for a legitimate reason, and I'm not talking about a market crash or a market correction that would essentially wipe out, all the stocks in the stock market. But let's just say Apple has a horrible year, and their stock goes down 50%. Well, then on the QQQ side, that's only 13% of your total investment. And the fact of the matter is, it's very unlikely that Apple is going to go down to zero, right? So they might lose 20% or 25% on some just horrible news, but that's not going to drop this thing down to zero. Same goes to Microsoft and Amazon. Each one of these companies could have a bad year or a bad press release or some sort of scandal, and they could conceivably dip. But I think that if you follow the stock market at all and just understand technology in general, then you know that it is very unlikely for these companies to have significant damage to their stock price, certainly over the next 3 years at the bare minimum, and many would argue, next 10 to 20 years. Okay, so those are the core holdings of the QQQ. Now I've gone through and I've highlighted a few names to give you some different angles that the QQQ allows you to play so that you get a feel for just how broad this investment is. Okay, so I labeled this slide diversity, and by diversity I mean the different sectors and categories that you actually play in. You see you have Nvidia on the chip side, Comcast, PepsiCo, Costco, Starbucks, ADP, CSX, if you're not familiar, is a railroad, for crying out loud. Regeneron, which is pharmaceuticals. Then you go down to the bottom, you got Monster Beverage, Lululemon. Bottom line here, this is not just tech stocks, folks. These are probably companies that are on the edge of technology, using it to push their business forward, but we're not just talking about tech stocks here. All right, on this one, I highlighted some international names. PepsiCo, Starbucks again, Mondelez International, JD.com, Booking Holdings, Mercado Libre. Those are just the names that are in the top 50 that stood out to me as international companies. But if you think about it, if you go back to some of the more popular names like Nvidia, Netflix, AMD, Heck, Microsoft, Apple, those are all companies that make a decent chunk of money in international waters. All right, and one more. These are what I would call the next gen winners, if you will. These are kind of like the ARK Invest names that you see that could stand out for the long future. Tesla, obviously, Nvidia, AMD, Illumina. There's just so many different names in here that if you ever woke up and let's just say Microsoft wasn't relevant anymore, it's not going to hurt you, right? Because these guys are going to slowly be creeping up the ladder if they continue with the pace that they're on. Take Tesla, for example, on the left-hand side. I would say that I'm closer to a Tesla bear than a Tesla bull. Now, I'm smart enough to recognize the success they have, and it's impossible to argue against their stock performance, but I typically wouldn't buy Tesla as a standalone stock. But QQQ, between a couple different retirement accounts, QQQ is probably 50% of my retirement savings, and I'm glad I have exposure to Tesla at 3.46% in the QQQ because it gives me that opportunity for the long term if Tesla continues to run. All right, so hopefully those slides gave you an idea of just how diverse and broad reaching the QQQ is. If you're ever talking with your friends or family gathering and you talk QQQ, you'll often hear older folks, if you will, say, well, that's just tech stocks and that bubble's going to burst and all these things. Typical type naysayer comments, if you will. But now you know, after going through that list, that it's not just tech stocks and there's a lot more to it. And in fact, if we woke up tomorrow and Pepsi and Lululemon suddenly were in every single house under the sun, their market cap would go up, and there's no reason that they cannot be the 1-2 positions on the QQQ, but it's based on performance, so they'd have to get there first. All right, so I'm trying to be cognizant here that I'm talking a lot of good news about the QQQ, so I do want to bring up what the perceived negatives are. So I'm going to share with you a clip from the Morningstar QQQ review, just so you understand both sides of the coin. All right, I label this my contrarian view. So this is important if you're not sure. You have to be comfortable in the stuff you invest in. You have to have conviction. So here's the other side of things. Despite its low fee and sterling recent performance, Invesco QQQ sector concentration and single exchange focus limit its appeal. It earns a Morningstar analyst rating of neutral. I'm going to skip down to the third paragraph. Narrowly focusing on the NASDAQ exchange does not make sense. It prevents the fund from owning high-quality U.S. firms listed elsewhere, which hurts diversification. For example, the fund missed out on Eli Lilly and Bristol Myers, which delivered excellent returns over the trailing year through April 2020 because they trade on the New York Stock Exchange. Fourth paragraph, this fund's single exchange focus also precipitates steep sector concentrations, particularly in technology. Its allocation to tech stocks, 47%, communication services, 20%, is consistently larger than that of the Russell 1000 Growth Index. As a result, this strategy's performance hinges on the fate of technology. All right, so let's be clear. Morningstar's been in the business for a long time, and not everybody's calling me asking for stock advice, right? So if you take their angle, it's too heavy in tech. It's not diversified enough because it only follows one stock exchange, and those things could cost you in the long run. They also claim that the Russell 1000 Growth Index is not balanced the same way as QQQ. So they're saying the growth coming in from small caps right now is not just 50% technology and 20% communication sector. It's filled with a bunch of other things. All right, well, bottom line for me, if I only had to own one stock, it would be the QQQ. It's about 50% of my retirement portfolio spread out of a couple different accounts, and I couldn't be more bullish on where this ETF will land over the next 10 to 20 years. Do keep in mind it's tech heavy, and it also is a high volume trading ETF. So this is actually good news though, because what you see is the QQQ can overreact in small percentages to news stories, right? So let's just say there's a fire at the Apple factory. If Apple stock dipped a lot, then the QQQ would typically overreact to that, which is great for a lot of investors because we can get in at a bigger discount for our dollar cost averaging. And another unwritten benefit of the QQQ, all those names we listed, if you hear somebody say, hey, what about Nvidia? What about Microsoft? You can stand up and say, yeah, I own that stock. Guys, hope you enjoyed this look at the QQQ. Please give me a like and subscribe if you did. We'll see you on the next video.